Well, futures, as we've been continuing to track them this morning, they are higher after that June CPI data came in cooler than expected, declining actually 0.1% month over month. A rise of 0.1% was expected. Joining us now, we've got Tom Porcelli, who is the chief U.S. economist at PGIM Fixed Income, and Greg Daco, who is the EY chief economist. Great to have you both here with us. Just want to get your read in. I mean, we were expecting a fractional gain on the all items essentially, but we got a fractional decline here. And so, I mean, are we on the train to deflation, or is it too early to declare victory at this juncture? Tom, I'll go to you first.
Yeah, so good to be with you all. Look, I think that we are on the train to the Fed teeing up a cut. Look, I think we were on that train before this number. But I think this number gives the Fed quite a bit of comfort. If you look at sort of some of the components, I get it, right? In so many ways, the shelter component is putting a floor underneath in inflation at large, and it behaved very sort of nicely this month. I would hasten to add, though, the thing that the Fed, one of the key reasons why the Fed even created this super core measure was to basically, in part, to remove the shelter component, because I think everyone sort of appreciates that it's just, there's some calculation issues there. So if you just look at headline CPI and you look at core CPI and you strip out shelter from both of those, you're now under 2%. You're running at a 1.8% pace. So I think the inflation fear that had been out there for so long, I think that the Fed is now, I think, moving beyond that, and I think the Fed is now really focused more on labor, which I would argue that they've actually been more focused on that for months. But I think Powell is now really sort of driving that home more out in the open. So I think with labor starting the process of slowing down, I think it's very reasonable to expect that the Fed will start the process of removing some of those hikes that they put in place.
Greg, do you think July is on the table?
July is on the table. I think it should have been on the table. I think June should have been on the table as well as an optimal time to recalibrate monetary policy. I think there's been way too much attention being given to this first rate cut. What we're talking about is really recalibrating monetary policy to today's circumstances and tomorrow's outlook. I think Powell was clear in his testimony to Congress, saying that inflation is no longer the main risk and the only risk that we face. We are in an environment where you and I have discussed this in the past, where inflation has been cooling. The underlying drivers of disinflation remain firmly in place. We have slower consumer spending. We have weakening labor markets. We have an environment where pricing power has diminished and where pricing sensitivity has increased. These are all disinflationary. So these types of reports that we just saw this morning, where inflation continues to ease, is exactly the type of report that the Fed is looking for as we continue to move closer to the Fed's 2% target. I think now is really the time to reconsider whether we need as restrictive monetary policy as we've had for the past year, or whether it's time to gradually recalibrate and avoid exerting too much pain on the economy at this delicate juncture.
I mean, this delicate juncture as well, just to follow up on that, Greg, is really because we have a general election as well in November that places them in the scenario of, okay, if we're going to seem apolitical, do we have to get out ahead of that with enough time to be able to cut, or wait until the dust is settled and then initiate that first cut? I mean, what is the calculus you imagine that the Fed is navigating through, especially as they do run the risk of remaining too tight for too long because of that central event that the political sphere is paying close attention to in the markets to a certain extent?
Definitely an optics element to the Fed's decision when it comes to the elections, but I think the Fed is really keenly focused on ensuring that inflation moves down in a sustainable manner towards its 2% target. There are a few policymakers that are still leaning towards the hawkish side, are not likely to be in favor of any imminent rate cut. But I think gradually we're going to see Fed Chair Powell lead a core of Fed policymakers towards adopting a softer monetary policy stance, a less restrictive monetary policy stance, and recalibrate. The numbers in this report were very interesting because we have one of the key elements that has been supporting inflation, as Tom was saying earlier, which has been shelter cost inflation, which is now moderating quite significantly. And at the same time, you're seeing pockets of softness on the services sector side. Hotel prices falling 2.5%, airfares falling 5%. These are signs of consumers exercising more prudence and businesses having to adjust their pricing in this more prudent consumer spending environment. I think the Fed should take note of this increased consumer prudence and recalibrate monetary policy, again, to today's economic realities.
Tom, when you take a look at the bond market's reaction here, you've got the 10-year yield right around that 4.2 level. You're also seeing a significant drop here in some of those shorter duration yields. Is that validated, do you think, by this print? And what does that signal then, do you think, for some of the action we could see in the coming weeks?
Yeah, one of the things that we've been trying to drive home is that the market has really been in sort of price discovery mode, right? Really trying to understand, what was going to happen from a sort of a policy reaction perspective. And I think, data like today, I think really sort of validate the idea that the market has been right to sort of price in a September cut over the last few weeks in particular. So, right now, if I look at, sort of what the pricing is for September, it's close to 90% priced in for a cut. And I think given a data point like this, I think that's quite right. And I think Greg makes such a really important point. I think if you consider sort of, we're all always focused on sort of calendar years. What's the Fed going to do this year? But I think more compelling is what's the Fed going to do over the course of this cycle? And I can easily make an argument that between now and, sort of just say the end of next year, that, you're easily looking at 150 basis points worth of cuts. And by the way, that's, again, just an arbitrary sort of endpoint. I mean, I think by the time all is said and done, I think that you could easily be somewhere between, sort of 3 and 3.5% from a Fed funds perspective. And again, I think given the backdrop, given the slowing that we've seen in inflation, given the slowing that we're seeing in labor, I think it's right for the Fed to make this a journey toward at least getting to neutral. And I think that's over the course of the next year and a half. I think that's probably the right way of thinking about this Fed.
All right, Tom Porcelli, always great to talk to you, Chief U.S. Economist at PGIM Fixed Income, and Greg Daco, EY's Chief Economist. Thanks to you both for making the time to join us here this morning.